Warren Buffett has just wrapped up some unexpected stock shopping. And guess what? He didn't just buy one, but 3 different stocks. That's right. This legendary investor, known for his Buffett investment strategy and a pioneer of value investing, made some fresh moves in the stock market, and we're getting real-time details on what exactly he's buying. Now, why does this matter? Because when Warren Buffett and his team at Berkshire Hathaway make a move, they don't do it randomly. Historically, Buffett has built his fortune through disciplined value investing by buying undervalued companies with strong cash flow and sustainable competitive advantages, principles that have shaped his investment journey and portfolio evolution. These moves often highlight key lessons from Buffett's investment history, including his focus on long-term growth over short-term gains. But what's special about these purchases is that we're getting real-time information on his latest investments. Typically, when a large investor like Buffett manages over $100 million, they're required to file quarterly reports with the SEC, which means there's always a delay before the public learns about their trades. However, when you own more than 10% of a company, as Buffett does in these cases, you must report your trades immediately. This rare, real-time insight into Buffett's portfolio changes offers a glimpse into his current investment formula and strategies, rather than waiting for the usual quarterly updates. Why Buffett bought these stocks? So, what's the reason behind these picks? Buffett's investment strategy has always been simple but powerful. Find businesses that generate consistent cash flow, have a strong market position, and are built to thrive over the long term. And right now, with the market facing volatility, he's likely looking for companies that can weather economic uncertainty and still deliver steady returns. Exactly the kind of picks you'd expect from a Buffett portfolio. One of these purchases is tied to a sector that remains crucial to the global economy despite ongoing changes. It's a business that has proven it can generate massive cash flow, even during price fluctuations, making it a reliable long-term bet, a perfect fit for Buffett's portfolio allocation approach. Another company he bought operates in a space where competition has increased, but it still manages to generate strong free cash flow because of its efficient operations. This echoes Warren Buffett's investment philosophy, where he often finds value in companies that continue to generate cash despite challenging environments. Buffett may see an opportunity here to benefit from consistent cash generation, even if growth slows. The third pick reflects Buffett's love for monopoly-like businesses, companies that have a near lock on their market and collect steady recurring revenue year after year. These types of businesses often make it into Buffett's recommended books as examples of enduring, high-quality companies. They tend to face less risk from competition and can deliver reliable cash flow with minimal capital investment. Together, these 3 investments show us that Warren Buffett's latest investments are still sticking to his classic playbook. Buying quality businesses with predictable cash flow, strong fundamentals, and the ability to withstand tough market conditions. It's a strategy that has served him well over decades and continues to shape his portfolio performance. Imagine if you had the chance to invest alongside Warren Buffett in these 3 carefully selected companies. Over time, businesses like these, focused on consistent cash flow, strong pricing power, and steady recurring revenue, can turn into cash machines for your portfolio. This is the essence of Buffett's investment strategy, which emphasizes investing in high-quality businesses with predictable cash generation. For instance, with a $100,000 investment, even a modest 10% annual return could grow to over $259,374 in just 10 years, thanks to the power of compounding, a concept often highlighted in Buffett's recommended books. And if these companies outperform, or if Buffett's strategy of buying undervalued stocks pays off as it has in the past, those returns could be even greater. Investing in businesses with proven resilience and the potential to thrive in volatile markets could be your key to building long-term wealth, just like Buffett's portfolio performance has demonstrated over decades. This approach, centered around value investing and picking businesses with strong fundamentals, is how Buffett continues to generate wealth year after year. Top 3 picks of Warren Buffett. Stock 1. Occidental Petroleum, OXY. Occidental Petroleum, OXY, is a leading player in the oil and gas sector with a market capitalization of approximately $48.14 billion. The The company has shown consistent profitability, with a trailing 12-month EPS of $3.65 and a price-to-earnings (PE) ratio of 14.05. Occidental's forward annual dividend is 88 cents per share, offering a yield of 1.72% at the current share price of $51.30. The company's payout ratio, which is the proportion of earnings distributed as dividends, stands at a conservative level, indicating room for future dividend growth, which aligns with Buffett's investment strategy of selecting companies with both profitability and financial flexibility. Buffett bought over $400 million worth of shares at prices ranging from $45 to $47 per share. This isn't his first move into OXY. He's been buying since oil prices were near $80 per barrel. But now, with oil trading below $70, he's doubling down. This reflects Warren Buffett's latest investment approach, where he focuses on long-term production potential and free cash flow. Occidental's vast domestic oil and gas assets make it a critical player in the energy sector. Did you know that for every $1 change in oil prices, OXY's cash flow shifts by $240 million annually? Clearly, Buffett sees value here, betting on a rebound in oil prices or at least stable long-term production. Classic Buffett value investing at work. The company's beta of 1.61 indicates higher volatility compared to the broader market, which is typical for companies in the energy sector. Over the past year, Occidental's stock price has ranged between $45.17 and $71.19, reflecting the cyclical nature of the oil and gas industry. Despite this volatility, the company remains a favorite among value investors due to its strong cash flow generation and efficient operations. Exactly the kind of qualities that make it a fit for Buffett's portfolio. Assuming a modest annual growth rate of 6%, a $100,000 investment in Occidental today could grow to approximately $179,000 in 10 years, $320,000 in 20 years, and $572,000 in 30 years. This projection reflects Buffett's long-term investment philosophy, which emphasizes compounding returns over time. Based on the current dividend yield, this investment would generate an annual dividend income of around $1,720 initially. If the dividend grows at an average annual rate of 4%, the annual dividend income after 10, 20, and 30 years could reach approximately $2,553, $3,774, and $5,580 respectively. This demonstrates the potential for both capital appreciation and passive income generation. Hallmarks of Buffett's portfolio performance. Stock 2. Sirius XM. SIRI. Sirius XM Holdings Inc., a SIRI, with a market capitalization of approximately $7.06 billion, operates as a leader in satellite radio services and audio entertainment. The company's current share price is $20.83, with a 52-week range between $20.47 and $55.40, highlighting the stock's recent volatility. Sirius XM offers an attractive forward dividend yield of 5.19%, with an annual dividend of $1.08 per share. Despite operating in a competitive environment with streaming services like Spotify and Apple Music, Sirius XM has managed to maintain profitability through a subscription-based revenue model and tight cost controls, key factors that align with Buffett's investment strategy of focusing on companies with predictable cash flow. Buffett bought around $100 million worth of shares, priced at approximately $22 per share. This gives Berkshire Hathaway ownership of nearly 30% of the company. While some view Sirius XM as a declining business due to shrinking subscriber revenue and increased competition from platforms like Spotify and YouTube, Buffett seems to focus on its free cash flow potential, which is consistent with his approach in building a resilient Buffett portfolio. The company is targeting $1.2 billion in free cash flow next year, which, for a business with a market cap under $8 billion, means it's trading at just 6 to 7 times free cash flow. This low valuation relative to cash flow is likely why Buffett, known for his value investing approach, sees an opportunity to benefit from cash generation, even in a competitive environment. Buffett likely believes the company can squeeze out even more efficiency, despite the industry's challenges. a characteristic he often seeks when making latest investments. Sirius XM has no reported P/E ratio due to its negative earnings per share, EPS, of negative 4.30 over the trailing 12 months, TTM, primarily driven by non-recurring expenses and one-time charges. However, the company's strong cash flow generation remains a key attraction for investors. The beta of 1.05 indicates that Sirius XM's stock is only slightly more volatile than the broader market, making it relatively stable compared to other media companies. Assuming a modest annual growth rate of 4%, a $100,000 investment in Sirius XM could grow to approximately $148,000 in 10 years, $219,000 in 20 years, and $324,000 in 30 years. With a current dividend yield of 5.19%, this investment would initially generate about $5,190 in annual dividend income. If the company maintains a 4% annual dividend growth rate, the annual dividend income after 10, 20, and 30 years would increase to around $7,680, $11,360, and $16,800, respectively. These projections highlight the potential for both passive income generation and long-term capital appreciation, which are hallmarks of Buffett's portfolio performance. Despite its challenges, Sirius XM continues to focus on sustaining its free cash flow and returning capital to shareholders through dividends, making it an appealing option for income-focused investors seeking consistent dividend growth and long-term wealth building, an approach that mirrors Buffett's investment philosophy. Stock 3. Verisign VRSN, Verisign Inc. VRSN operates as a dominant player in internet infrastructure, specifically in managing domain name registrations. With a market capitalization of approximately $19.9 billion and a current share price of $207.08, Verisign continues to generate stable revenues from its near-monopoly position in the domain name registry market. The company's P/E ratio stands at 24.16, reflecting investor confidence in its consistent earnings, while its EPS, trailing 12 months, is reported at $8.57, showcasing strong profitability, a quality often sought in Buffett's portfolio. Buffett invested around $45 million in Verisign at prices between $190 and $196 per share. Verisign manages critical internet infrastructure, including the .com and .net domains. It's a classic toll booth business. Every time a domain is registered or renewed, Verisign collects a fee. This model aligns with Buffett's investment strategy, which favors businesses with steady recurring revenue and pricing power. With steady recurring revenue and minimal operating costs, Verisign generates nearly $900 million in free cash flow annually. Its monopoly-like status gives it pricing power, and while growth in domain registrations has been flat, the consistent buyback strategy rewards shareholders. Buffett's team clearly values the stability and long-term cash flow of this business, reflecting his approach to building a resilient Buffett portfolio. Despite operating in a competitive and evolving industry, Verisign has maintained a high level of operational efficiency. The company's beta of 0.91 suggests lower volatility compared to the broader market, making it relatively stable for investors seeking predictable returns. Verisign does not currently pay a dividend, choosing instead to reinvest its earnings and engage in share repurchase programs to enhance shareholder value, an approach that resonates with Buffett's long-term investment philosophy. Assuming a conservative annual growth rate of 6%, a $100,000 investment in Verisign today could grow to approximately $179,000 after 10 years, $320,000 after 20 years, and $572,000 after 30 years. Without dividends, the returns from this investment would rely entirely on capital appreciation, driven by consistent revenue growth and potential share buybacks. While there is no annual dividend income from Verisign, the company's continued focus on enhancing profitability through cost control and reinvestment provides potential for sustained long-term growth. Investors who prioritize capital gains over immediate income may find Verisign appealing due to its market leadership, predictable recurring revenue model, and strong financial fundamentals. With a 52-week range of $167.05 to $213.68, Verisign's stock price reflects its resilience amidst market fluctuations, making it a classic example of a Buffett investment strategy aimed at maximizing long-term shareholder value. So, what's the final takeaway from Warren Buffett's latest stock purchases? Whether it's businesses with steady cash flow, monopoly-like market positions, or those with efficient operations, one thing is clear: Buffett remains focused on long-term value creation. These three investments highlight key principles that any investor can learn from. Stick to fundamentals, seek out companies with a proven ability to generate consistent returns, and don't be afraid to buy when there's volatility in the market. A hallmark of Buffett's investment strategy. Imagine if you had invested $100,000 in companies like these, following Buffett's strategy of buying high-quality businesses. Over time, with compound growth and reinvested earnings, that $100,000 could potentially grow into hundreds of thousands of dollars, or even more, while generating a steady stream of passive income. This illustrates the power of long-term investing and staying disciplined, even when market sentiment fluctuates, just as Buffett's portfolio performance has shown over the years. At the end of the day, investing isn't about chasing the hottest trends. It's about finding companies that are built to last and letting time do the heavy lifting. And that's what Buffett has done throughout his career. Whether you're a seasoned investor or just starting your investment journey, the key lesson here is to focus on businesses that deliver real value over time. Now, the big question is, will you add any of these stocks to your watch list or portfolio? If you found this breakdown helpful, don't forget to like, subscribe, and comment below. We'd love to hear your thoughts. Do you agree with Buffett's picks, or do you have your own strategy for finding great investments? Thanks for watching, and remember, invest smart, stay patient, and keep building your financial future. See you in the next video.